Good morning, good afternoon, good evening, no matter where you are in the world. This is Howie, and I'm here to help you win with money. In this episode of Exposed by Math, we're going to cover options trading and why it's a zero sum game. So let's start by defining what is a zero sum game. It's really a topic in math that's under game theory, and basically all it is if you think about a two-player game, somebody wins, somebody loses, like in chess or checkers or a draw. If you think about money, think about two people betting against each other. The money flows between the two people. Now, if you think about a more complicated game, let's say a game of poker, where everybody puts in $100 at the beginning of the game and there's five players on the table. You play until somebody wins all the chips, which means at the end of the night, somebody's going to win the 500. It's a $100 buy-in from each of the five players. You play until everybody loses but one. So that's a zero-sum game. Wealth is not magically generated or created by anyone, but it's really a transfer mechanism between all the players involved. So let me show you a visual. I have a really simple visual here. So here you go. B is the buyer of options, S is a seller. So what happened in this case is the seller is obviously receiving the premium, is the $10, but on the other side, the counterparty risk, right, depending on who you are, obviously if you're B, the counterparty is S, and if you're S, the counterparty is B. But you see that the $10 that B is, he's buying a contract, so he's going to send money to someone else. S is the seller of the contract. He's receiving the credit. And this is how it works. In a nutshell, it can be outcome one, B wins, S loses, or the reverse, B loses, S wins. Another way to look at it is what happens if you now you close the position. So let's look at it in this way. B and S are still the same, but what happened is data decay happened. The seller, S, now wants to close his position. So he's going to spend $3 to close his position. And now you got a new seller, NS. The way I showed you over here is B still loses the 10. S now receives his 10. But then he wants to now close his position. So he's going to spend the free out of the 10 he received, netting him 7. So he's ending the game at 7. And the $3 go to this person, the new seller. So the $10 gets split by the free parties, but if you add them all up, you got a minus 10 plus 7 plus free. You always net to 0. And that's what you expect in a zero-sum game. Hopefully you understand that. Now sometimes the classic example of this particular case is if B and S are really the only two people in the world and they want to close their position, right, in one sense, you can look at it this way. B is the minus 10, S receives the 10, you want to close it, you move the $3 back, it's a plus 7, so this guy gains a $7. This guy is now minus 10 plus 3 equals a net value. So he lost $3. This guy, I'm sorry, I said that wrong. He lost $7 because he only got the $3 back, but he lost 7 in total, and this guy gained the 7. But if you add the two up, it should always add up to 0. Now, in real life, we also understand there's slippage and fees. What I mean by slippage is the bid ask. The price is never exact, right? There's a little spread difference there. And also commissions and fees for your broker. Most people pay 65 cents, 50 cents, 40 cents to your broker. So that causes this game to be a negative sum game. Let's talk about this particular video. Let's watch this short one. This is about a 2-minute video.
Recently, I've been wondering if the markets are truly random and efficient price, how is any one strategy better than another strategy? I understand the long-term buy and hold works due to the general uptrend or positive drift in the markets over long periods of time. However, if trading the tasty way, how can one be profitable if options are efficiently priced? Wouldn't that mean that even with high probability of success strategies, it's basically still a zero-sum game?
Well, no, I mean, it's a zero-sum game if it was like a binary option where you just had to set it and forget it. You couldn't buy it back or trade it intraday. Since you can get out at any time, since you can change the position at any time, so you can do whatever you want on it, it's not only a zero-sum game, it's a game that constantly changes and is dynamic all day long. So for me, this whole thing comes down to use of capital. What's the best strategy I can use with as least amount of capital to maximize my return? And at being a zero-sum game, man, you can get out anytime you want or add to a position. It's not a zero-sum game at all. It's quite dynamic.
This is a very interesting question because it comes up a lot in the Tasty universe. And if markets are truly random and efficiently priced, which we do believe, and how is any one strategy better than another strategy? And if you're holding everything to expiration and you're just letting everything run its course, theoretically, it is pretty much a zero-sum game.
Right.
We don't ever say, or we don't believe that we have any theoretical advantage whatsoever. It's just not possible. Nobody that buys or sells something has a theoretical advantage because the counterparty would never sell it with negative edge. Just think about that to themselves. So we never argue that there's a theoretical advantage. What we do argue is that there's a mechanical advantage. There's a trading advantage. And the trading advantage is you get to do whatever you want to do when you want to do it. And so you can use a set of mechanics like Tasty mechanics that will give you a little bit of what we call a mechanical or trading edge. And so you can control when you get in, when you get out, what you trade. And so we argued for that reason, it's not a zero-sum game. Are we saying it's an easy game? Not at all. But are we saying that it's a fair game? Absolutely.
Okay, so let's go over what they said in the video. Tony said it's not a zero-sum game because it's dynamic. You can get in, out, alter your trades, roll, this, that, and it's not a binary option. So that is some of the weirdest thing I ever heard. Remember, these two are supposed to be experts in the industry. I don't remember how many years, 10, 15, 20 years of trading. And they come up with, that's his best answer? You got to be kidding me. Tom sort of says it in a different way. It's a zero-sum game, but he's like, well, because we teach you something else. The theory is a zero-sum game, but what we teach is it's a mechanical advantage. It's your trading edge. Okay, so I get that. But they still didn't address the elephant in the room. What everybody wants to know is options trading a zero-sum game? How hard can this be? In checkers, you're playing two people. One win, one loses. What's so hard about that? Now, this is the part that most people don't understand. If you increase the number of players, let's say the value is n, we don't know how many winners or losers there are. It's not n divided by 2. Now, one would think it's n divided by 2, right? Half the players win and half the players lose. The number of players winning and the number of players losing is a little bit harder to explain because it's not so straightforward. And I'll try to explain this in a very different way. In trading, one player can trade one option or a million options. If you got 10 players and each one has a different number of trades, it becomes very hard because you got to pair it with somebody on the other side of the trade. So you can't do like a weighted average or anything like that. You can't just do A times B equals, that's the weighted number of trades they do, and then let's sum everybody's number of trades up, and it will divide it by the number of n of players, and that will work. It doesn't work as simple as that. Hopefully you follow along. So for each player, you can do one or many trades. But for every trade that you put on, there's a counterparty or another trader on the other side. The trader with the best skill will win. But that trader could be one person. And there could be 99,000 losing traders on the other position. So let's just use a really stupid example. If one trader does 1 million trades, and then on the other side of it, you need like, let's say 99,000 other traders doing the other 1 million trades. And this one trader always wins and everybody always loses. So here's a scenario where the winning percentages are not 50-50, it's 0.0001. Okay? Now, obviously I use a really stupid example, but that's exactly what's happening in real life. I do 1,000 trades a year or more. Last year I did 1,346, I think. And I did a video on how many trades I did last year. My winning percentages were well over 84, 85%. So yes, and I net a profit, right? That's the most important thing. At the end of the year, doesn't matter how many trades I put on, but if I'm always making money trading every year, then that means I'm beating a lot of other people who are losing money every year. Some people don't stay in the game long because when your account goes to zero, you're out of the game unless you reload or refund a new account, right? You heard of the term, I've blown my account. Maybe you sit out of the game until you fund a new account. But I don't have to fund anything because I'm always winning. So you're transferring wealth to me. And this is the part that's hard for most people to understand it. Most option traders who are winning don't actually like boasting about it because I always need other people to take the other side of the trade because I'm beating somebody on the other side. But you got to understand the math. It's not a 50-50 mechanism. Anybody who believes that should not be trading and needs to go back to school and take some basic math classes. This is not hard to understand. It's a wealth transfer mechanism and not everybody wins. Okay, so let's read this particular article. What percentage of traders fail? If you read this, it says our research says about 70 to 80% of traders lose money. How is it possible then, right? And they go into this thing here. Brokers are required to disclose percentage of people losing money. And this is what is a CFD, contracts for different. It's a derivative. Look, it talks about it's 100% zero-sum game, but even negative when just for slippage, right? And look at these numbers. None of these numbers suggest it's 50-50. No matter how you read this, it's even if it's a zero-sum game and there's two parties and there's one winning person on one trade and a losing person on the other trade, because of the nature of option contract, most people row and this and that and you do many trades, right? You adjust your position. But it still doesn't mean it's 50-50. Because the amount of winners, generally speaking, the better the winners are, the more they play, and they take the other side of the position of the other losers. And so one winner becomes a bigger, he becomes a bigger percentage of all the trade. So as I get better, I'm not going to just stick to 1,000 trades. I'm going to now play 2,000 trades and 5,000 trades. And if I'm really good, I would love to get to 20 million trades in the future. Which means I'm going to beat a lot of people just on my own. And you're all transferring wealth into my account. Now, let's just go on. How is this possible? And it goes on and talks about how many traders fail at Robinhood. It doesn't really tell you. It doesn't give you the answer. Why do traders lose money? Now, this doesn't really talk about it because he tried to then introduce other things like stock market. And that just confuses everything. Because I don't want to bring in stock market, right? Stock market is a totally different beast, different mechanics. What you want to do is, let's stick to options trading. Why is option trading, even the best account here at Interactive Broker, 58% of people lose money, which means only 42% are making money. And actually, I do think it's somewhere around 25% of real option trader or active option traders are making money. And I do think about 3/4 of them are losing money. So when you understand this concept of options trading is always a zero-sum game, and that you got to recognize that the winners, the people who are winning in options, eventually start trading more and more and more. So there's actually fewer and fewer winners eventually, or all the winners sort of make up the volume, and that it can handle more of the losing trader. So let's talk about the other challenge. Some people say you can have two winners still, and they bring in, not all option traders are playing a certain way. They're using options to hedge against their stock market portfolio. Maybe they're buying protective puts or something of that nature. And then their argument is, well, they made money because they use options and hedge. The insurance really only cost them, let's say, I'm making something up. It cost them less than 1% of their portfolio, but their portfolio jumped 5%. And so the cost of insurance was small because they made profit on the underlying. So the argument then is both the option trader won, the underlying that went up 5% using a 1% insurance hedge still won because his net worth gained. So that is a true example, but what they forget is they try to complicate the math by introducing apples and oranges comparison. They're saying the guy who was playing with apples and oranges is now winning because you got to sum it up. But they forget then to count, well, orange to orange, somebody got to win and somebody got to lose. So they confuse these arguments to make it complex, to make it sound like option trading is not a zero-sum game because you can have two winners. The options trader or the orange guy who's only trading options could have the winning side of the trade, and then the guy with the apples and oranges was using the hedge and he made money on his stock portfolio because it went up 5%. His insurance leg was only a minus 1% for the cost of it. But that confuses everybody. But in the end, when you look at the math, stock market is not a zero-sum game. And so this is why people get confused. And it's still not even explained clearly. Because stock market, a lot of people can win, a lot of people can lose, and the answer is always somewhere between the two extremes. And what I mean by that is, if you look at an Apple stock, Apple became like a $2.5 trillion market cap. But it's not because Apple raised $2 trillion. You don't need every share to trade to get all that cash infused into the stock market, because that's where wealth creation comes from. How can every Apple shareholder lose? If Apple suddenly was worth $0 tomorrow, the rush to the exit couldn't be done fast enough. And that's sort of what happened in Netflix today. Netflix is down 30% because of their earnings came out and they lost 200 subscribers. So yes, the money magically disappeared, because even if only one share traded, and if that one share was $100 lower, it just magically disappeared. And that's why stock market can be where a lot of people lose if you're holding WorldCom, Enron, or those type of stock. Or everybody can win, because when Apple goes to these new highs and it's worth $2.5 trillion, not everybody needs their money today. Only a few people sell their shares that need to live off it, so they extract their money out of their holding. Other people just keep on holding the stock. So when you understand that, stocks are not zero-sum. You can create wealth or you can destroy wealth, but it's always somewhere in between. Option, there is no ifs, ands, ors about it. There's no confusion. It is a zero-sum game. And you got to understand that you cannot look at the math and confuse it and then try to explain it in a different way. What that tells you is, if you don't understand options trading and how not everybody can win, I think you need to stay out of it. Now, why should you trade options then? Once you understand this, there are lots of great reasons to trade options. I'm still a buy and hold investor in my stock market portfolio. And there are times where I use options to gain income strategy, like a covered call. There are times where I use it as insurance, and I do bet against my own long holding. There are other times where if you're up 500%, 1,000%, you use options as a hedge, maybe to protect some of your gains in case the stock falls. So there are many ways to play it. And yes, it becomes a drag on your portfolio. The cost of writing options is not free. If you're using it as insurance, if I'm making 10% a year on my stock market portfolio, and if I'm using options mostly as a hedge, that can still cost you 1 or 2 or 3% of your portfolio, depending on how you're hedging. And again, I'm not going to get into that in this video. If you're hedging against the VIX, if you're hedging or you're just using like a protective put or whatever you're doing, there's a cost to it. It becomes a drag on your portfolio. But comment below. Let me know what you think. Hey guys, if you want to know more, you should watch a lot more of my other Exposed by Math videos. I do my best to try to explain it to make you a better investor. I'm not here to sell you garbage. I'm not here to tell you what you want to hear. If you want to make money, I can help you. If you want to win and have the right mindset, that's what I can do to help you. In any case, hey guys, thumbs up, like, subscribe. Let's do this together. Let's do this $1 at a time and have a profitable day. Bye-bye.